Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update for the week of December the 30th, 2019. I hope everybody had a Merry Christmas and a very happy holiday season, and I wish you all the best coming into the new year of 2020. So, starting with the market state, we are in a bullish market state one, and as a reminder, Canterbury categorizes the market state environments as either being bullish, transitional, or bearish. Bullish markets have kind of low and decreasing volatility and more stable fluctuation compared to transitional and bear markets, which can have high and increasing volatility and kind of erratic fluctuation. So most new market highs do occur during market state one, which is again what we're in right now, and that's kind of a characteristic we are seeing right now. Canterbury Volatility Index currently measures a volatility reading of CVI 46. And this volatility level is low and decreasing, and we're actually on the cusp of entering into what we call extreme low volatility. And as we've talked about, many updates in the past, extreme low volatility is like the squeezing down of the spring. Low volatility and decreasing volatility is a good characteristic, but sometimes when it gets too low, it needs to release some pent-up pressure in the form of, an outlier day or two where you see a spike in volatility, and that spike can either occur up or down in the markets. Looking at a short-term volatility index, that currently is already in extreme low territory at CVI 29. So that's something to be aware of there. The market, has seen a sharp advance over the month of December here and over the last couple months in general. We can kind of contrast this to last year where the market saw the opposite, saw kind of a sharp 20% decline off the peak value. And as we come to the end of the year, it's really important to remember that markets simply don't operate on a calendar basis. The market doesn't just shut off and kind of restart going into the new year, and you kind of have to look at the total picture. So while 2019 shows this, kind of sharp advance in the markets, well, that's coming off of the low that occurred at the end of last year where you saw a 20% drop, and then you have this rally begin the new year. So again, markets just don't shut off and restart. Investing is a lifetime endeavor, and the game is constantly continuing. Your investment life is constantly moving forward. So this year is expected to be littered with many campaign ads, and also because we're going into the election, but also there's going to be many different market predictions. If so and so wins, the market's going to go up, and if so and so wins, the market might go down. But we have to remember that nobody can predict the future, especially when it comes to the stock markets. Nobody can predict exactly what's going to happen. But fortunately, we can measure the characteristics of the markets today. We can measure the volatility of the market, and as volatility begins to increase or decrease, we can measure when the market's beginning to change, when it's going from a low volatility bullish market to a transitional market to a bearish market. And we can kind of make the necessary adjustments to keep our portfolio efficient, regardless of what kind of market environment we head into. But kind of going back to the idea that the stock market has seen kind of a parabolic move upward recently, we often associate kind of sharp, quick rises in the market with sharp, quick declines, and sharp, quick declines with sharp, quick rises. And an example of this is going back to December of 2018. Again, you saw that sharp, quick decline, followed by that sharp, quick rally to start 2019. And I just want to make an observation about kind of today's market, compare that back to the market we saw at the end of 2017, beginning of 2018. Now, no two markets are exactly the same, but they can often rhyme, and the emotions that occur during kind of similar looking markets can often, kind of feel the same. And so if we're looking at the end of 2017, beginning of 2018 market in this chart here, we can see that, the month of January 2018, we saw a sharp parabolic advance in the markets. And this parabolic advance was coupled with extreme low volatility. And as we mentioned before, extreme low volatility, you're more likely to see spikes in volatility. And that's exactly what you saw. You saw a sharp parabolic rise and extreme low volatility. You then saw some of that pressure be relieved in the form of multiple outlier days in a row, where you saw a sharp, fast decline over the course of a couple days. Similar to today, we are seeing a sharp parabolic advance in the markets over the last month. We're also entering into extreme low volatility. So again, when we enter that extreme low volatility, we could see some outlier days here that could result in a sharp, fast decline, similar to we saw to what we saw at the beginning of 2018. Now, that's not necessarily guaranteed to happen. It's just something to be aware of that is something that could happen kind of heading in here. Since you have extreme low volatility, that it is a little bit more likely than it might have been, just a couple months ago. But if we're talking about the Canterbury portfolio thermostat and its efficiency, currently measures an efficiency score of 100, which is efficient for the market environment, has low volatility at a volatility index reading of 30. It's got a bullish portfolio state, and it has benefit diversification of 38%, which is good for a bull market. We don't want to see a low benefit of diversification, because if the market does have some volatility spikes, all of your securities in the portfolio will be correlated and kind of go down together. A benefit of diversification of 38% means that all the assets being held are in bullish security states, so they have the right characteristics for the market environment, but they're not all correlated to each other, so that is good. Kind of bottom line here, there's a lot of optimism in the markets right now, kind of given in that parabolic advance, but market pullbacks are certainly likely to occur in each calendar year. We've seen a couple different pullbacks this year, but as our good friend and award-winning market technician David Voman wrote in his kind of update, he said that the odds of a 10% pullback in any given year is far greater than 50%. And the average yearly pullback is about 16%. And pullbacks are normal in markets. They are expected, especially kind of when we see these large run-ups that we've seen for most of 2019. And we don't know when, and we don't know the extent of the pullback that might occur. It could be far greater than 16%. But it is good that the Canterbury portfolio thermostat is an adaptive portfolio strategy. So it's capable of making the adjustments and holding securities that can benefit from whatever market environment is to come. So if the market environment begins to change, we can measure that and the characteristics of the market with the volatility, and we can make the necessary adjustments to make sure that the portfolio has maintained low volatility, a bullish portfolio state, and an efficient level of diversification. So again, everybody, I want to wish you all, kind of a happy new year. Get out there and celebrate with your loved ones, and we look forward to talking with you next year. Thank you, and have a great rest of your week.